On a cold October morning in 1929, people across New York opened their brokerage accounts. When they looked at their balances and saw their fortunes had climbed past $1 million, they thought they had reached the peak of their lives. But just a few days later, those same people would watch it all disappear. So did they make bad investments? No. Were they scammed? Not that either. They simply believed in one single thing, along with almost everyone else at the time. The stock market always goes up. And here's the strange part. This wasn't a small group. Millions of people made the exact same mistake. People took out loans from banks. Some even put up their homes as collateral and poured everything into the stock market. Because to them, losing simply wasn't a possibility. But within just a few days, that dream turned into one of the greatest economic disasters history has ever seen. In this video, we're going to look at exactly how the 1929 stock market crash began, why it spiraled out of control within days, and how it went on to reshape not just America, but the entire world, including things that still affect our lives today. But to understand what happened in 1929, we first need to go back a few years. Because at the time, America was living through extraordinary prosperity. Thanks to Henry Ford, cars were no longer a luxury reserved for the wealthy. Factories had practically evolved overnight. Plants that once built weapons for war were now producing automobiles, radios, and household appliances. People were earning more, spending more, and looking toward the future with enormous hope. In short, everyone was thinking the exact same thing. The hard times are behind us now. The economy was growing so fast that people assumed it would simply never stop. New companies were forming, new industries were being born, and it seemed like someone was getting rich almost every single day. And that sense of comfort gave birth to something new, the stock market. Buying stocks used to be something mostly the wealthy did, but by the late 1920s, that had changed completely. The market was no longer just for businessmen. The grocer down the street, the school teacher, the carpenter, the cab driver, pretty much anyone with a little spare cash had started buying stocks. Because everyone was thinking and saying the same thing. Buy today, sell for more tomorrow. People had started treating the stock market almost like a money printing machine. There's actually a famous story from that era. You'd sell it, pay off the loan, and walk away with a very nice profit. And people love that logic. Joseph P. Kennedy Sr., father of future U.S. President John F. Kennedy, was getting his shoes shined one day when the shoe shine boy started giving him stock tips. So Kennedy went and sold every single share he owned, because he thought to himself, if even the shoe shine boy is in the market, then everyone's already in it. And he was completely right, because there was no one left to push the prices any higher. That idea turned out, in hindsight, to be one of the earliest warning signs of the crash. But in 1928 and early 1929, almost nobody was paying attention to warning signs. Confidence wasn't just high. Looking back, it was dangerously unquestioned. But here's one of the most critical parts of this story. Most people weren't actually investing with their own money. Most of the money flowing into the market was, in fact, borrowed. This was called buying on margin. At first glance, the system looked incredibly appealing. Say the stock you wanted to buy was worth $1,000. You'd put down just $100 of your own money. The remaining $900 would be lent to you by your broker. If the stock went up, great. Why use my own money when I can borrow and make even more? Once everyone started thinking that way, an enormous amount of borrowed money began flooding into the market. But there was one thing nobody accounted for. What if the stock went down? That's when everything changed. Your broker would send you a warning. This was called a margin call. The message was simple: either deposit more money into your account right now, or we sell your shares for you. The problem was most people didn't have extra money to deposit, so they were forced to start selling. But when everyone sells at the same time, prices fall even further. As prices fell, new margin calls went out. As new margin calls went out, even more people were forced to sell. And just like that, a chain reaction began that was nearly impossible to stop. By the summer of 1929, a huge portion of the money in the stock market wasn't people's own money anymore. It was borrowed money. And on top of that, there were none of the serious regulations we have today to oversee any of it. So millions of people were essentially placing one massive bet, largely financed by debt. And when that bet collapsed, it wouldn't just hurt investors, it would hit the entire economy. By September 1929, warning bells had already started ringing. From the outside, everything still looked great. The market was still high, people were still investing, but behind the scenes, the economy had quietly begun losing strength. Factories weren't producing like they used to. Sales were slipping. The real economy could no longer keep up with that incredible rise happening in the stock market. In fact, a well-known economist of the time, Roger Babson, gave an outright warning. Sooner or later, a great crash is coming, and the effects could be severe. After his statement, the market dipped briefly, but since it had dipped and bounced back before, most investors didn't take it seriously. It'll happen the same way it always does, they thought. But it didn't. October 24th, 1929. The day that would go down in the history books as Black Thursday had arrived. From the early morning hours, people began selling their shares in a panic. That day, nearly 13 million shares changed hands. For that era, that number was almost unimaginable. Selling was happening so fast that even the machines displaying prices couldn't keep up. People realized far too late that the prices they were seeing on the screen were actually hours behind reality. Nobody understood what was happening. Crowds quickly gathered outside Wall Street. Everyone was asking the same question: what's going on? As the panic grew, the most powerful bankers of the era came together. They pooled their own money to buy large amounts of stock, trying to project confidence back into the market. And for a brief moment, it actually worked. The market recovered slightly. People thought the crisis was over. But in reality, they had only bought themselves a few days because the real problem was still there. That massive bubble, inflated for years by borrowed money, hadn't burst yet. On Monday, October 28th, the selling started again. This time, there was no one left to stop it. The market lost roughly 13% of its value in a single day, and the very next day, October 29th, 1929, Black Tuesday. By now, everyone was doing the exact same thing: selling. Price didn't matter anymore. People just wanted out at any cost. That day, more than 16 million shares changed hands. Trading was so heavy that exchange records weren't even finalized until after midnight. In just a few days, the stock market had lost roughly a quarter of its total value. Fortunes built up over years vanished within days. But the disaster didn't stop there, because the money that had been lost wasn't only investors' money. Remember, most of that investing had been done with borrowed money. When investors couldn't repay their loans, the banks themselves started taking the losses. As banks began to fail, panic spread among ordinary people. Everyone rushed to pull their money out of the banks, but the banks didn't have nearly enough cash on hand to cover everyone. Thousands of banks collapsed one after another, and back then there was no system in place to protect people's bank deposits, which meant someone who had never bought a single share of stock in their life could still lose their entire life savings just because they happened to keep their money in the wrong bank. People stopped spending money. Businesses couldn't make sales. Factories cut back production. Then came the layoffs. People who lost their jobs spent even less. Less spending meant even more businesses failing, and the economy spiraled into a massive, self-reinforcing downward cycle. By 1933, roughly 1 in every 4 workers in America was unemployed. But then another mistake made things even worse. The U.S. government, trying to protect domestic companies, placed heavy taxes on imported goods. Other countries responded in kind. As a result, global trade came to a near standstill, and the crisis stopped being just America's problem. It became the entire world's problem. This era went down in history as the Great Depression. Years later, governments learned some critical lessons from this disaster. Systems were created to protect people's bank deposits. Regulatory bodies were established to oversee the stock markets. Much stricter rules were introduced around borrowing money to invest. Many of the financial safeguards we take for granted today actually exist because of what happened in 1929. And maybe the biggest lesson from this entire story is this: the moment an entire market starts saying, all at once, prices are only going to keep going up, that might already be the most dangerous moment of all. If you found this useful, make sure to subscribe. Every week, we cover a new piece of the financial world, from history to strategy to the people behind it.